Imagine waking up with 5,000 euros ready to invest. But here's the big question. Where do you put it? How do you make sure that it continues to grow? And more importantly, how do you keep building wealth after that? A significant portion of my wealth has come from investing. But if I had to do it all over again, this is exactly how I'd do it. And to be honest, there are a few things that I would do differently. By the time that you finish this video, you'll have a clear plan how to build your investment portfolio, and this could save you costly mistakes along the way. Okay, let's get started. Hi, I'm Kevin Elliott. Welcome back to the channel. I help educate and empower people to take control of their finances, enabling to build true wealth. If that sounds like something you need, make sure to hit the like button and subscribe for more personal finance insights. I remember when I landed my first job in the City of London. I was making £50,000 per year. At first, I felt like I'd finally made it until I realized how expensive London was. Rent, transport, nights out, the money disappeared faster than I expected, but I had a plan. My plan was to get into finance, work hard, save aggressively, and then get out to set up my own business. Seems simple, right? Well, that dream, however, forced me to think smarter about my money. Instead of spending everything I had, I committed to investing a portion of my income every single month. Fast forwarding 5 years, and I wasn't just getting by, I built up a safety net. My investment portfolio had grown significantly, and that put me in a position to explore new opportunities. Essentially, it gave me options. The startup idea that I had, well, that was put on hold. But I used part of the investment growth for the deposit on an investment property. And that is the real power of investing. It gives you freedom, gives you options. It is not just about the money. Looking back, I wish I'd understood one thing sooner. The earlier you start, the greater the impact of compound interest. If you're in your 30s, you have more time than money. This means that you can take bigger risks because time is on your side. In your 30s and 40s, you likely may have a mortgage, a family, and more financial responsibilities. Your ability to take risks decreases. And from 50 onwards, you need to start focusing on retirement. So becoming more conservative is key. You cannot eliminate risk, but here's the reality. If you start early, your money has more time to grow. The earlier you start, the less you have to actually invest to reach the same goal. By now, I assume everyone has heard of NVIDIA. In the last 5 years, they've risen from relative obscurity to becoming a dominant force in the technology world. Their share price has grown almost 2,000%. That's an 85% annualized return. To put that into context, let's say you invested 5,000 euro 5 years ago. Today, it'd be worth around 103,000 euro. But here's the thing. NVIDIA is one of what's known as the Magnificent Seven. Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, and NVIDIA. These companies have driven a huge portion of the S&P 500's growth. In 2023, the S&P 500 grew 24.2%. But if you took the Magnificent Seven out, the growth would have just been 4.1%. In 2024, the S&P grew 23.8%. But taking the Magnificent Seven out, the growth would have just been 6.3%. But let's look back in history. The top companies in the S&P 500 have changed dramatically over the last 30 years. In the 1990s, companies like General Electric and IBM dominated. By the 2000s, it was Cisco and Intel, and today it's the Magnificent Seven. What will the top 10 companies be in another 10 years? Well, if you know, you can let me know. This is why betting on individual stocks is risky. Companies, they rise and they fall. But the market as a whole always tends to grow over time. This is exactly why Warren Buffett, one of the greatest investors of all time, recommends index funds for the average investor. Buffett says, a low-cost index fund is the most sensible equity investment for the great majority of investors. So, what are index funds? So instead of buying one stock, you're buying hundreds or thousands of stocks all in one fund. It's like owning a piece of the entire market rather than betting on just a few companies. The best part, you don't need to guess which companies will dominate in the future. Whether it's NVIDIA today or another company in the next 10 years, an index fund automatically adjusts, so you will always own the winners. And the performance speaks for itself. Over the last 20 years, major index funds like the S&P 500 and the MSCI World ETF have consistently outperformed most actively managed funds. Other benefits of index funds: lower fees. Index funds have lower expense ratios than actively managed funds, meaning more of your money stays invested. Next is consistent performance. Historically, index funds like the S&P 500 have delivered between 8 and 10% annual returns over the long term. Then they also offer hands-off investing. There is no need to research and pick individual stocks. Index funds automatically find the best companies and adjust them for you. This enables you to essentially set and forget. Now we know that index funds are one of the best ways to build wealth, but let's break down the different types available and how you can buy them today. So broad market index funds, these offer global exposure. If you want instant diversification across the entire world economy, global index funds are a great choice. The MSCI World ETF, this tracks large and mid-sized companies across 23 developed countries like the US, UK, Germany, and Japan. The FTSE All World ETF, this includes both developed and emerging markets, offering even more exposure. And finally, the Total Stock Market ETF. This covers large, mid, and small cap stocks in the US and worldwide. These funds are perfect if you want to invest globally without picking individual countries. One of the most famous and widely recommended index fund is the S&P 500. Why? Because it tracks the 500 largest US companies which have historically delivered between 8 and 10% average annual return over the long term. In addition to the S&P 500, other US-based ETFs are the NASDAQ 100 and the Dow Jones Industrial Average. The NASDAQ 100 is a tech-heavy fund focusing on the 100 largest non-financial companies that are listed on the NASDAQ stock exchange. It includes major technology giants like Apple, Microsoft, Nvidia, Amazon, etc., making it one of the fastest growing indices in the world. Historically, the NASDAQ 100 has outperformed the S&P 500, delivering higher long-term growth, but it also experiences larger price swings. If you want exposure to the US economy, the S&P 500 is one of the safest and best performing options. Looking beyond the US, there are many regional index funds available. So for example, the Eurostock 50, this tracks the largest companies in the Eurozone, so LVMH, SAP, Siemens, etc. And the FTSE 100, this tracks the UK's largest companies, including HSBC, Unilever, Shell, etc. So how should you invest your €5,000? Here's my approach, and it is tailored to different risk tolerances. Investopedia defines risk tolerance as the degree of variability in investment returns that an individual is willing to withstand in their financial plan. It reflects an investor's capacity and psychological readiness to endure potential financial losses in pursuit of potential gains. Factors that influence risk tolerance include an individual's financial goals, investment timeline, income, and comfort with market volatility. Individuals with a high risk tolerance, that is, those that are comfortable with market volatility and understand that short-term losses may lead to long-term gains. They should invest 80% in the S&P 500 and 20% in the NASDAQ. So that'll be 4,000 in the S&P and 1,000 in the NASDAQ. Those with a medium risk tolerance, they should invest 90% in the S&P 500 and 10% in the NASDAQ. So that'll be 4,500 in the S&P and the remaining 500 in the NASDAQ. And then finally, those with a low risk tolerance, people with a preference for stability and capital preservation over higher returns. Ultimately, they're looking to minimize losses. So they should invest 100% in the S&P 500. Let's look at the projected growth of the different investment scenarios based on the three different risk tolerance levels. We're assuming here that the initial €5,000 investment is enhanced with a €500 monthly contribution. Here we see the projected growth over 5, 10, and 20 years based on the different risk tolerance levels. So for a high risk tolerance, we assume a 10% annual return based on the 80-20 split between the S&P and the NASDAQ. After 5 years, the investment grows to around 47,000. After 10 years, 116,000, and after 20 years, 416,000. A medium risk tolerance with an 8% annual return based on the 90-10 split between the S&P 500 and the NASDAQ. After 5 years, it's forecasted to grow to 44,000. After 10 years to 102,000, and after 20 years to 319,000. The low risk tolerance, where 100% if it goes into the S&P 500, we assume a 6% annual return. After 5 years, it's forecasted to grow to €42,000. After 10 years to 91,000, and after 20 years to 248,000. If you already have the Degiro app, Follow these steps to buy the S&P 500 ETF or the NASDAQ 100 ETF in just a few minutes. Log on to the app. Step 2 is to search for the ETF that you want to buy. Tap on the search bar at the top of the app. So for the S&P 500, search for the ticker CSPX. This is the most popular, it's low fees and it's tax efficient. For the NASDAQ, search for C. Step number 3 is to place your order. Tap the buy button and then select the order type. So a market order buys immediately at the current market price, or a limit order sets a maximum that you're willing to pay. And this is useful in times where the market is pretty volatile. Enter the amount that you want to invest. So it's 5,000 or monthly, maybe it's 500. Tap confirm order to complete your purchase. And then step number 4 is to sit back and monitor your investment. You can track the S&P 500 or the NASDAQ in the portfolio section of the Degiro. Consider setting up automatic monthly investments to grow your wealth steadily. Let's talk about investments. Here's how to stay on track. Number 1 is to automate your investments. Set up a recurring deposit into your investment account every month. Pay yourself first and let the market do the rest. Number 2 is to avoid temptation. Don't chase get-rich-quick schemes. Stick to your plan and ignore the noise. Number 3 is be patient. Don't check your portfolio every day. Studies show that frequent checkers tend to make the worst decisions because they act on impulse. They buy and sell when they shouldn't. Number 4 is to increase your income. Look for promotions or side hustles or ways to earn more. The more you invest, the faster your wealth will grow. Look for ways to increase that monthly contribution into your investments. Investing isn't all about getting rich overnight. It's about building wealth over time. Small, consistent steps lead to life-changing results. All right, let's quickly summarize what we covered today. Step number 1, invest your 5,000 euros wisely. Step number 2, automate your investments. Contribute monthly. Step number 3, stay consistent and let time do the work. Drop a comment below to what's your investing plan for 2025. And if you're serious about growing your wealth, hit the like button and subscribe for more investing tips. I'll see you in the next video. Until then, happy investing.